Welcome to the Cardinal Commentary for the Canadian equity portfolios. While Canadians aren't expected to head to the polls until next year, the U.S. election will be held in the first week of November. The good news for markets is election years typically produce strong returns on both sides of the border, as the incumbents are highly motivated to increase government spending to boost the economy. And that's usually the biggest election issue. The Canadian economy has had a bumpy ride of late, alternating between good and not so good quarters amid rising unemployment. We believe the Bank of Canada could start cutting interest rates as early as June, beating the Federal Reserve to the punch in the U.S., to counter the fears that continuing high rates will trigger a recession. Portfolio manager Sheila Wilson-Cole says the key indicator for the Bank of Canada is inflation.
So they do want to see inflation continue to decline and kind of get to around that 2% area before they make a move. They also take into consideration how the economy itself is doing, how the employment picture is looking. So when it comes to ultimately going from the pause cycle phase that we're in to actually cutting rates, they want to take all that data into consideration and make sure that they're making the best decision at that time, because of course they don't want to end up having to backpedal and make a move towards raising rates again down the line.
While we appear to be entering a good news cycle for the first time in a while, it's important to remember that there are still two major wars going on, plus several more that simply don't make the news anymore. And while we monitor the situations regularly, they are unpredictable events that could impact portfolios. But no matter what's going on in Canada or around the world, we continue to invest in companies that perform in all conditions. CCL Industries is one of those companies. In fact, we can guarantee that you have a number of CCL products in your house right now. It provides labels and packaging products to industries such as food and beverage, personal care, pharmaceutical, apparel, electronics, and automotive. Here's equity analyst David Amy.
CCL Industries is a global packaging leader and one of the largest label manufacturers in the world. We really like the label manufacturing industry because although it only costs a company a penny or two to buy a label, that label is used for marketing and to convey critical information to consumers to purchase their products.
CCL fits perfectly into the Cardinal investment strategy, increasing its dividend from less than 16 cents per share 12 years ago to $1.06 per share last year, a compound annual growth rate of 19%. 8 of our companies increased their dividends in the first quarter, led by Boardwalk REIT at 23.1%, followed by Brookfield Corp, Gildan Activewear, Intact Financial, Manulife Financial, CCL Industries, CN Rail, and TC Energy. The S&P TSX underperformed most world indexes in the first quarter of 2024, but our Canadian portfolios continue to outperform when it really matters, like over 15 and 25 years. And here's the proof. If you had invested $500,000 in the Cardinal Canadian equity portfolios in 1993, it would be worth more than $10.3 million today, far outstripping the benchmark. And why do we do all this? Because it works. And that's the Cardinal Commentary for the Canadian equity portfolios. Thanks for joining us.